Looking through the AT&T numbers, they came in line with earnings per share and with the revenue number. But it was some of the comments that Randall Stephenson made that are probably more important, just saying that they're on track right now in terms of paying down debt.
That's right. And in fact, they raised their free cash flow guidance. So all in all, the results are pretty good, right? I mean, that's not to say there are no areas for concern. This is a big and complicated company. The number of satellite subscriber losses is sort of terrifying, how quickly that business is unwinding.
Was it faster than expected? Because
778,000
TV versus like
665, which was already horrific. So you're looking at that business, the premium video subscribers, as they call them, including Uverse, shrinking now at about 8.8% a year is terrifying.
That's because they've rolled off some of the incentives that had kept people there before?
Some of that is there. Well, in effect, in that segment, and I don't want to focus too much on that segment because it's not the whole story, but in that segment, they're raising prices in order to stabilize EBITDA. But what happens when you raise prices in a declining business? It declines even faster. So the challenge will be next year, how do you reconcile a business that's losing subscribers at close to 10% a year? That's a tough thing to do.
Your grand takeaway, though, is focused on what? What do you think is the most important piece?
So look, I think most eyes today are going to be on the merger between Sprint and T-Mobile and what that means for industry structure for AT&T's wireless business. The wireless numbers are pretty good. They're back to positive service revenue growth. The subscriber number for phone subscriptions was a little better than expected. And by the way, while people don't pay much attention to the commercial wireline business at AT&T, that's a huge business. It's about the same size as the entire company of Time Warner, just to put it in perspective. And nobody talks about it very much. And they actually did pretty well. EBITDA grew. It's been falling pretty rapidly. It grew by 1%, and the revenue decline there was only about 1%. So all in all, there's probably more good than bad here in these results today.
You said it's going to be overshadowed by the T-Mobile Sprint deal, which was kind of cleared. The path was cleared for that last night after Dish agreed to pay $5 billion for wireless assets.
That's right. So earlier this week, or end of last week, we wrote that there are three scenarios. There's one scenario where they agree to a network hosting deal and the industry structure is worse after the deal than it was before. Bad news for everybody. Scenario two,
sorry, play that out. Help me understand that.
Had they agreed to a deal, and it looks like they have not, a deal that created a network hosting agreement for Dish, so putting Dish's spectrum on Sprint T-Mobile's network and really putting Dish into the business. That would have been a negative for the whole industry because Dish would have such an incentive to discount. The third scenario, to skip to the other end, was that they walk away and they couldn't get to an agreement because Deutsche Telekom would refuse to do a network hosting deal. The middle scenario, scenario two as we called it, and was the fig leaf scenario. Essentially an MVNO agreement or virtual agreement where they can sell capacity on Sprint T-Mobile's network. What we hypothesized Friday and what I suspect is still true, and it sounds like that's what we agreed to what was agreed to last night, is that that's not going to be enough to satisfy the staff at the DOJ, even if it satisfies Makin Delrahim.
So, and then what?
And so that very likely means the states proceed with their lawsuit, and you're still in this kind of awkward netherworld of I don't know whether the deal is actually going to be approved or not. But that scenario, I think you can make a pretty good argument that scenario doesn't really make Dish all that credible a competitor. If it survives, it's great news for the industry because you do get something like the kind of market repair that everybody talked about. But I don't think you can bet on that surviving the legal challenge.
Sprint is up more than 4% this morning. T-Mobile up 1.75%.
That's right.
That's the right move for the markets? Is that what you would be?
Well, it's interesting, right? Sprint is not fully discounting the exchange ratio because the market is, I think, rightly saying it's not entirely clear if that's the deal that's going to survive legal challenge. So a lot will depend on what the staff at the DOJ does.
So you think potentially traders are getting ahead of themselves with it?
No, not necessarily. I think they're still saying this is a step in the direction of the deal's more likely.
But if you think the states are going to hold this up for 12 more months, that's a problem unto itself.
Sure.
A big one.
And I think it's very unlikely that this is a deal that the states will say, okay, that's good enough, we're going to back off.
Can I bring us back just for a moment to AT&T? Because we were having a conversation in the 6 o'clock hour about the issue of how much debt AT&T has, and to the extent there are people that are skeptical longer term about AT&T and the transaction with, still they look at Time Warner. HBO Max, they announced, I don't know if it was announced today, but I know they commented in the release today that HBO Max is going to launch in spring of 2020. They haven't announced what kind of price that can come with. I think there was an expectation early on that there could be a $4 or $5 kind of price to that in this environment, given with Disney at $6.99 and where Netflix is.
It has to be at $17 plus.
So if that's $17 plus, what does that do to your calculation? I mean, do you look at that and say then it was a worthy transaction? Does it change the math of all of this?
Disney's $6.99 pricing is a big problem for AT&T because AT&T's HBO business can't be cheaper as a direct-to-consumer service than it is on Comcast and Charter and everywhere else. So you have to be at $17 plus. I suspect when they bought Time Warner and they contemplated a direct-to-consumer play, their assumption was that was where the market would be. When Disney came out at $6.99, it throws a hand grenade into their plans because how do you price at 17 plus when Disney's at $6.99?
And Netflix is basically at the price of HBO. That's
right. So the challenge, and you can see the challenge they're facing, right? HBO right now reaches about 30% of U.S. households. In a best case scenario over the next couple of years, including HBO Max, they'll get to eventually 30% of households paying about the same thing as they are today. So that business will be about the same business it is today. But in the process, you will have burned Turner and the TV studio to the ground because the licensing revenues that you used to get externally are now just being pumped into HBO Max, and Turner channels are going to be distributed in a way similar to that. So it's going to be tough to make 1 + 1 + 1 equal more than 1.
Is Disney at $6.99 risking cannibalizing its own revenue streams too?
Sure.
And I guess are they just willing to take the hit because they want this to get big and they want to hit the?
They're making. It's funny how the three players that have announced strategies, Comcast with what they've said about their NBC strategy, AT&T with what they've said about their HBO Max strategy, and Disney have taken very different views,
routes,
right?
And do those collide at some point?
It's hard to imagine that all three of them are right. AT&T's is to some extent think of Comcast as the most conservative strategy. Disney's as by far the most aggressive, and AT&T's somewhere in the middle. And Comcast is talking about, well, we can do this with AVOD or advertising supported without a subscription, but they're mostly thinking about let's preserve the status quo. AT&T's doing something in the middle. There's like Comcast, they've started to pull back some content and move it to their direct-to-consumer service. That means foregoing some licensing revenues they otherwise would have gotten from players like Netflix. But it is not an abrupt change.
Disney's pulling like the
Disney
Amazon
saying,
Walmart strategy of just we want to make up for this in mass.
But importantly, Disney, I think, is thinking about it in a nuanced way, which is the strategy for the sports business for ESPN is completely different than the strategy for the entertainment business. I think they understand sports is going to be distributed via the traditional model. It's going to have to start raising prices.
Disney already got the bounce on the stock. If that's the wrong strategy, it's going to come back down.
Yeah, you're right. And one of the things that's really interesting is Disney did get a bounce.
Huge.
It's hard. It's
billions in market cap, Craig.
Absolutely.
And it's for $6.99 and no profit margin.
And it's hard to imagine Comcast or AT&T getting a similar bounce for a similar strategy. And so one of the challenges is, everybody compares themselves to Netflix and says, can we do what Netflix did? Well, not if you didn't get the stock price that Netflix did, because Netflix is able to keep investing in part because...
Which strategy do you think actually works if they're on a collision course?
Well, some of what we're going to see even this quarter is probably a swing back to, in some ways, the status quo. The rate of decline for linear video is still accelerating, but the virtual MVPDs are dying. So the idea that everybody was going to go to these virtual packages, my guess is this is going to be a really rough quarter for virtual packages. And that has to be very scary for the media companies, right? Because it means you're still losing the traditional distribution, but you're not getting it back in virtual distribution. And so you're just plain losing distribution. And that's a scary model, right? Because it means all you can do is start raising prices faster and faster and faster to make up for the subscriber declines. But what's that going to do? It's going to create an even faster spiral downward. But if you're a sports network and you have a contract with the NFL or with Major League Baseball, you have no choice because your input costs keep rising. Right. You have no choice but to raise prices faster and faster and faster.